Welcome to this month's free training webinar, and we're going to be talking about the 1120 tax returns. Now, when you're working as an underwriter, I always kid around that you got to be kind of like part CPA, part underwriter to be an underwriter, because you have to understand how tax returns work. Now, in our previous webinar, we actually did what's called the tax return roadmap. And if you want information or a copy of that, just email us and we'll be happy to send you a copy of that recording. But on that recording, we actually touched on how the 1120 is kind of the mystery missing one. And we're going to explain today why it's not on the personal returns, how to detect it, and basically how to handle certain rules. We're not going to really focus directly in the calculations, what to add, what to subtract. We're going to get to the point of how you identify what you need, where you find it, all the other things that 1120s has, and then doing the math, sticking into a spreadsheet or Blueprint Income Expert is going to be the easy part. So let's get to this. All right, so before we actually get to 1120, let's do a quick review of what we talked about in the roadmap. Now, again, we want to remember is the 1040 is an executive summary of taxable events. Every single person that you see out there has a 2-page tax return, whether you make $1 or $1 billion a year. Now, I can stop right here and say, I know you're going to say, well, wait a minute, this borrower just gave me 180 pages or 300 pages or 1,000 pages. The tax return is the 1040 is 2 pages. The supporting documentation can be 10 pages or 100 or 1,000 or more, depending on how complex their tax return is. But everything in all those supporting schedules filters down to a 2-page item. Think of like the 1008 in the mortgage business, right? The 1008 takes all the information, all the pages of app credit, puts it on 1 or 2 page, I think, with the addendum layout, right? So you can quickly summarize what's going on, and then you know what to dig into further to figure out what else you need to know. All right, so for lenders, remember the other thing too, when we talk about IRS versus lenders' use of a tax return, for lenders, it's just to point or find income. You can't really calculate most incomes using the 1040. There's always supporting documentation you need to go extra on it. But for the IRS, it's just adds everything up and says them as taxes. So most cases, again, with the 1040, you're going to need to ask for additional information. And this training on the 1120 today will help you understand what information is needed to round out what you need to do underwriting. All right. Now, one other quick reminder as we went through the tax return roadmap, if you're looking at this training, this is the 2025 version. It's 2026, February 2026 has been recorded, but we're on the 25 tax returns because obviously you file tax returns after the year is up. So just to assure you, there's no material changes that affect underwriting on the 2025 tax returns, except for the one little thing, which is on Schedule C, which we're not talking about today. But one of the boxes as an underwriter looks at is line 27A it's an addendum line that says, hey, this box represents another form that's got a whole bunch of entries in it. And some of those entries like casualty loss, amortization can be added back in cash flow. It's now line 27B. But other than that, I'm going to show you the tax returns. They do look a little different, kind of how cars update their model. It's not a new model. They just kind of fix the grill a little bit or put a little different colors in it, but it's the same car, right? You notice a little changes, but it's not radically different. That's what's going on with the 1040 here in 2026, looking at the 2025 returns. All right. Now we have to know, remember the whole point of this training is how to dig down through things and know what to ask for from our borrower so that we don't over ask or under ask so we can get the calculations done. Now, basically, remember what tax returns you need. January 1st through April 15th, you can take the 2024, 2023. Now, between January 26th and April 15th, you can start using the 25, 24 once you know they've filed the tax returns. Now, quick little story on the side, during my 32 years in this business, I've been an underwriter pretty much a little over 30 years of that, I was an auditor for 3 or 4 years during that career. And, we fix fraudulent files and loans that crash. So you do a lot of kind of like forensic underwriting of what happened and if there might have been fraud. And when I say when they file it, once you know they filed tax returns, you cannot use the 24 and 24, 23 anymore because they're going to find out. If you do close that loan and the borrower defaults, and let's say it's a year, 2 years later when they default on the loan, and they do an audit, they're going to pull a 4506T. They're going to know exactly when the taxes were filed. And they're going to say, that's weird. This lender submitted me 24, 23 tax returns, but they knew, or the borrower had already submitted the 25, 24. Maybe you're trying to cover up declining income. not going to fly, right? That's not, you're not the Lex Luthor of mortgage crime, right? They kind of know what's going on with this thing. So when I say possible as soon as filed, just make sure during these, February, March, April timeframe that you say, hey, I need these tax returns. But if you're going to file before we close, I do need the new ones. And this may affect your approval. So you might need to think about when you file your tax returns, all right? So just FYI. Now, once we get past April 15th, you have to use the 25-24 unless you got an extension, then you can still use the 24-23. But once we April 16th until the new filing season 2027, which starts over in the same pattern, you have to use the 25-24, no exceptions. If they don't have it done, you can't issue a loan, Fannie Freddie, if they need tax returns to qualify. Now, the 1120 has the 1120 has kind of a little thing where it uses sometimes a fiscal year, not the calendar year. So, it's not January 1st through December 31st. It can be September 1st of 2024 to September 1st, so August 31st of 2025. They can offset the year a little bit. Once they start there, they have to stay there permanently. You won't see this often, but it's very confusing, and we're going to address that later on in the presentation. All right, so as promised, I want to show you a quick review of these things. I'm realizing my camera might be kind of a little bit over here. Hopefully it doesn't blind it too much, but basically the lines are the same. If you look, line 1A is tax returns, line 10, schedule 1. The difference in the 25, see the line 10 is way down here at the bottom, right? So I'm going to click on it, trying to get the yellow thing to go off, but it's way down here. But what happened was they added a bunch of information up here about dependents that made it push all the lines down. And a few of the lines to do with only tax deductions rolled on the second page from the 25. So nothing big. You're still, lines are the same. You're looking for Social Security, it's line 6. You're looking for IRA, line 4. Nothing changed there. All right. So no worries about any big changes as we're doing some training today. If you know the 24s and 23s, you're going to know the 25s. They're virtually identical. All right, now let's do a reminder about how people have to build tax returns, because we get this question often. Hey, my borrower has filed an extension on the 25 tax returns, but they gave me their business returns for the 1120 or any other business for 25 and 24. You can't do that. The first thing you have to do to complete your personal returns is you have to complete your business returns. Even if you're doing an estimate, you have to do your business returns, or you're doing an extension, you have to have a reasonable idea of the taxes. How are you going to figure that out if you haven't done your business returns? So it doesn't work that way. Yes, they may have the business returns done because you have to do them first and then your personal returns, but you can't file the extension and say, well, I don't know what my business is, or I want to use my business without my personal. What's in the guidelines for Fannie, Freddie, FHA, VA, USDA is the personal tax returns set the year, not the business returns. So if your business is done in 25, but you haven't finished your 25 tax return, personal, you got to use the 24-23. So the personal tax returns are the goalpost for what you're supposed to be using. So you build your business returns, what is it, 1065, 1120S, 1120. It kicks out K1, dividends, whatever, which you're going to hand to your tax preparer, which is probably the same person doing your personal tax return, but they do a checklist and they start assembling everything, because once they have your business information, and then you gather up all your deductions for license plates and state taxes and donations and marital credits and all the things, right? You grab all that for them. They put it all together and you get your personal tax return, right? So it's always that order. Business gets done first and then personal, then you file your personal, and then we can start evaluating your income. Now up here, I put this little orange arrow. This is where your 1120s are hiding at, right? They're in the W-2 or the dividend form. There's no tax returns going to show up, or no K1 or anything like the other type of businesses. And we're going to go over all that. Okay. Now let's talk about the legal reason why the 1120 is missing. The primary reason is a C Corp, which is 1120. They use 1120 tax form, not 1120S. The C Corp does not appear on an individual's tax form in the same way 1120S does. Both are corporation. One is a pass-through entity and one is a separate taxable entity. It's like a different person. It's kind of like when you have kids. When they're below 18, they have to kind of live under your roof and your rules because they're not an adult. But once they're 18, they're their own person, right? They are completely legally an adult, and they can do all the things adults can do. They can buy a cigarette or whatever, probably buy a gun, whatever. All the things you can do when you're 18, right? Vote, join the military, etc., etc. Get a tattoo. We all know the things you can do when you're 18. So what happens is a C corp is treated as a legal person, like it's a completely separate entity from from the person. So it actually pays its own taxes and everything. It doesn't pass through the money, and it's 21%. Now, a quick note on why you don't see a lot of people own these 1120s. Oh, and let me define something. In 1120s, there's both a public 1120 and a privately held or family 1120. Okay, they're different forms. The reason they're public is, like Amazon is 1120, Ford is 1120. So if you're going to go to the, and sell shares on the stock exchange, you become a public corporation. Now, you don't actually have to sell shares on the stock exchange to be public either. You can be big enough where you want to become public, but that means people can read your 1120s, right? Because it's like, hey, you're a corporation, I want to invest in you, or I want to work with you, and you can, if it's public, you can get the information and look at it, just like you can a nonprofit or something like that. You will not run across somebody that's getting a mortgage application with a public 1120. They're going to have a private or closely held 1120. The form looks the same. You won't know any different than I'm aware of. You're just looking for the 1120. That being said, all 1120s pay a 21% tax rate. So when you get your income earned, let's say the business brings in $1 million and then has $200,000 of profit at the end of the year. Okay. And this is, by the way, after you pay, yourself in a W-2 as the owner, right? So you get wages because you are an employee of the business, because you work for the corporation and you own it. 1120 is the same way. Blueprint is 1120S. I get a K1 and I get a paycheck like all the employees here. I'm the owner and an employee at the exact same time. So I have income coming from two sources. Okay. Same with 1120, except for they only have a W-2 where I have a K1. So it's a bit different there, but it's included in those losses or those gains. Once I take that 200 grand, I have to pay 21% tax on that, right? So now I got 200 grand, that's $42,000. So now that 200 grand is cut down to 160, right? Or 158. And that W-2 wages I paid myself, the 100 grand, I got to pay whatever, 22, 24, 12, 14 more percent taxes on that too, plus Social Security taxes, that's 7 more percent. Between the two of them right there, I got over 50% taxes, and then throw on state tax and local tax, right? So this is where, you don't see these a lot because they're heavily taxed. Now, the double taxation thing is like, look, as a shareholder of 1120, the reason there's nothing flowing into your personal tax return, it's already paid the 21% flat rate. So there's nothing for you to add on personally. What you're going to pay extra is, the taxes based on your dividend earnings and your wages, depending on what your tax rate is. Because, with federal taxes, they're a sliding scale. Most states' taxes are flat. I'm in Michigan. I pay 4.25% whether I make $1 or $100 million, right? Federal taxes, slide. The more you make, if you're married or not married, they slide up to, I believe, 37%, I think is the top rate, once you're over like $1 million or something like that. I don't know that rate because I don't earn that kind of money. So anyway, that's kind of what's going on there, right? So this is why you don't see a lot of these. And if they are using them, they're generally not very profitable. They're more for security or protection, like you own a bunch of real estate and you want to make sure that they can't sue you personally. You put it in 1120. That you'll see that a lot of times too. And they're not generating much revenue, so you don't worry about the 21%. A lot of times you can show a loss and you pay no taxes anyway. So, okay. So if you look at the bottom of the 1120S and 1120, you can see this is 1120S. It just says, hey, what's your ordinary business income? So if there's two owners, let's say it's like Blueprint. I'm 50% owner, my partner's 50%. If this says 200 grand, 100 grand's on my K1. It splits this line 22. And on that K1, it goes on my personal return and I pay taxes on my personal level. Now, if my partner gets the other 100 grand on his K1, if he's in a different tax bracket, even though we both made the same amount of money, let's say his wife makes, she's a doctor and she makes 500 grand a year, and I just, earn my 100, he's going to pay a lot more taxes on his 100 than I'm going to pay on my 100 because it passed through to me. The 1120, no such animal. It's got this total tax on line 31. So you pay your taxes, you get taxable income on line 30, and you pay that percentage on line 31. So there's no getting out of that, just so you kind of know the difference there. All right. Now let's talk about the 1120 workflow. So if you don't identify them when you're looking at personal tax returns, how do you find them? So the first thing is, hopefully the loan officers ask the borrower about ownership. Now, the first 2 years of this business, I was a processor underwriter or a processor loan officer, and I would take applications and I use a story format. That's what, like, I was always taught, have a conversation, don't sit there and read an application to somebody. So the story was, hey, so good news, you're looking at buying a new home. Why are you moving? Oh, is this going to be your primary? Is it going to be a vacation home? Oh, what are you doing with your old home? Are you going to sell it? Oh, great. Oh, you're doing a refi. What's the primary purpose for refi? Oh, rate and term refinance, right? So you just talk with them. And once you got down the app to like how you make money, I always said, hey, how you earning money these days? And they say, oh, I work at Ford as an engineer. Of course, I'd know not to ask for tax returns because they don't own Ford. But they would say, oh, I'm self-employed. Now, look, I know tax returns because I'm an underwriter mortgage guy, but a lot of business owners, like my doctor is self-employed and he asks me all his mortgage advice all the time. He barely knows his own taxes. He's a doctor. He has a CPA. Because I've asked him, like, well, how do you file your taxes? 1120 or 1120S? He's like, I don't know the difference. So most of your borrowers are not going to know if they're a 1065 partnership or 1120S. They might be aware of it slightly, but they're not experts. So loan officers should be sending in a letter going, hey, I asked the borrower, and they're like, yes, I am 25% owner. And then as a loan officer, you now need to ask for what type of tax, return do you file? Oh, you're an 1120. Give me your personal returns, and I can look through what you need. And I'm going to ask you if you're an 1120 because I won't see them on a personal return. Now, as an underwriter, if the loan officer fails to get me the explanation, I just look for things like the borrower's names match the company. If you're the president of Whitbeck Airplanes, right, and your name is Mike Whitbeck, more than likely you're probably one of the owners. Maybe your grandfather started. I don't know. So you have to ask. Or you're the CEO of WAB3, right? And you're like, well, you're the CEO. Hey, as CEO, do you have ownership in the company over 25%? You're going to ask questions based on their position and name matching. The other thing too is you're looking at their personal returns. It's going to come up if they have any ownership, they're going to have a share, and dividends are paid when there's profit. When they want to kick them out, they don't have to. But if they decide that they want to pay dividends, which is profit, they can kick it out through a Schedule B or a 1099, right? Now, once you kind of figure out that they are self-employed, you can confirm their percentage ownership off the 1125E, which is a list of all the officers, how much they work there, and their percentage of ownership shown in stock, right? There's two stock numbers. I think it's preferred and ordinary. You add them up, and it says, if it's over 25%, you're self-employed in our world. If you add them up and they're 10%, they're an employee, right? All right, now that we know, how to find these or what can be on here, you're looking at tax return, you can see again, the wages would be up here in the W-2 box. Again, this is a summary. This person could have one W-2 or 25 W-2s, and it could be taxpayer 1 or taxpayer 2. This just shows you they have W-2 wages, and it might be worth asking a question if any of them came from the business. And, from W-2 wages come from 1120S's, 1120s, and in a rare case, a single member LLC, which is on a Schedule C, which is very rare, but that's where W-2s can come from, in addition to working for an employer. And the other thing too is the dividends. If you're scanning down the tax returns, you see some qualified dividends. It'd be right here under ordinary dividends. On the bottom is qualified, and it would just say the name of the company that matches their employer. So these are places you'd see it at. Again, dividends are, especially these small, closely held 1120s, are not common, but these are things you may see that you might be able to use for income, but most of the time you can't use these. Okay, now let's talk about some guideline differences, and also we'll talk about the shifting time. But first of all, one of the things about corporations is the shifting of time. This thing confused me for many years. I still kind of doubt myself. I always look this up and redo it. But what does it mean when Fannie Mae and Freddie Mac talk about corporate fiscal year? And when funds from a corporation operate in a fiscal year that is different from the calendar year, so in other words, it's not January 1st through December 31st. What if the corporation's years are October 1st through September 30th the next year, which is very common. Nonprofits do it, but corporations can do it sometimes. Anyway, what they mean by time adjustments is this. I used to think you had to divide up the tax return and figure out what they got paid in one year versus the other. That's not what it means at all. So I put this little chart together trying to better explain it. So when they're aligned in the calendar year, what happens is the 1120 tax form kicks out the 25 W-2 and possible dividends in the same year. So you see a 25 1120, you see a 25 W-2 and dividends that all line up exactly to the 1120 because they're in the same year. And that would be the same, whether it was 24, 23, etc. When they have time shifts, this is all that's going on. What happens is the tax form you use is based on the start of the time frame. So if I have a September 23, again, go back to my example, October 1st, 2023 through September 30th, 2024, I would be using a 2023 tax form. Now, when you're working with the borrower, what happens is it's 2025 and they filed their taxes and you find out they have 1120. You're going to see dividends for 25. You're going to see a W-2 for 25, but there is no 2025 1120 yet because the last filed one is a 2024. And all the W-2 wages that are listed here don't all come from here, but they don't have any further taxes. So all it means by time shift is when you ask for the most recent filed tax year, you're going to get the personal 1040s and you're going to see the dividends on there and they're going to give you the W-2, but they're only going to give you the 2024 dated tax return because there is no 25 yet. It's just a shift. So no math, anything like that. That's what they're talking about. You have to time adjust. So if I turn this in for audit, I would have the 2024, 2023, 1120, but I'd only have the 24 and the dividends and 25 dividends and W-2. It's not math. It's just simply lining up the forms. That's what they mean by time shifting, right? So, and the other thing too is you're going to need to know when you'd expect to see the next one. Well, I think they basically have a quarter, and don't quote me on this stuff. This is deep CPA stuff, but from my reading, you basically have 3 months or 4 months to file the tax return once your time ends. The same way that we get till April. So if your time period ends December 31st, you get to April to get the filing done, right? So 3.5 months. It's about the same for this. So if it ends in September, I got October, November, December, January, so I got to get it filed. All right, so that's roughly what's going on. And again, all right, the next thing is, remember, there's some very restrictive rules about using the cash flow analysis. Now, remember, when you are a business owner, 25% or greater, you use the business returns and cash flow adjustments if they qualify with liquidity passing, and the W-2s and maybe the dividends if they got it. All right, but with Fannie Mae, you cannot do that at all, no cash flow adjustments, unless you're 100% owner. The only exception is if you and the other person on the loan are both owners, like you and your spouse, each own 50% or whatever, that's still 100%. So on the app, if both people equal 100%, that's considered 100%. So I know it doesn't say it that way, unless the borrower, it should say borrower, S, but you can get away with it. I've never seen a problem with it. What they can have, though, is you're 50% owner, so you cannot do the cash flow adjustments. You can, however, do the W-2 because that's your income, right? And you can do the dividend because that's your share. So you can do that on there. Now for Freddie Mac, they're a little convoluted. They actually do allow below. Let me see if I can move my camera here. They do actually allow, but you can see what's really crazy is this is not calculation income, it's access to income. So what they're saying is if you are 100% owner and you want to do cash flow adjustments, that's fine. But if you're not 100% owner, Fannie Mae would say no. But Freddie Mac's like, well, if it's not reported on their federal tax returns or you're not in a category above, which, if you're 50% over, that's not in a category, now you got to verify the legal right to business income and it's not encumbered or restricted. Good luck getting that. That's really hard. This is where, I don't know if Freddie's really enforcing that now. And Freddie's one of our partners, obviously. We're on their income. If you go on the Freddie website, we're one of their approved vendors. So I know that we do talk, but it's just one of these things like, I don't think they're enforcing this very well yet. I'm pretty sure if you have 50% and use cash flow, it's fine. Just like they never used to enforce the distributions until 2015. So I'm telling you, but you're like, oh, they don't do that. You probably don't enforce it. But, I always kind of joke around, like the speed limit in Michigan is 70 or 75, depending where you're at. I can do 79 miles an hour and go right by a state cop. They say nothing about it because there's so many people doing more than 79 miles an hour. It doesn't make 79 miles per hour right. They're just not enforcing it. But if they pull me over and give me a ticket, I can't complain. I was speeding. And if Freddie Mac comes after you and says, hey, there's 50% owner and you gave them all this cash flow, but you got no evidence that they had access to it, well, you're busted, right? So don't think they're enforcing it, but just the letter of the guideline says you have to. Okay, I'm just going to give you the background there. All right, well, hope that helps clears up a little bit 1120. I know it's a bit of a mystery. Now, as far as calculations go, let me share with you something else here. Let me switch my screens. Now, we don't really go over calculations in this webinar, but I just want to at least make you a little bit familiar with them. Now, I've got Blueprint Income Expert pulled up. If you don't have Blueprint Income Expert, email us. We'll tell you about it. We do 30,000 loans a month. We're 13 years in business, 3.6 million loans analyzed, fully rep and warranted, approved by both vendors. So we're very well known in the industry, been around for a long time. That being said, so I get the 1120 calculator up, and you can see it's laid out what you're supposed to do. What do you have for W-2 wages? I'm doing a 2-year analysis. This is Fannie Mae. I'm doing 100%. I got my cash flow adjustment set in there, and you can see it's kind of adding them all up and giving me the income. Now, the great thing about our calculator, it knows how to follow the rules. And, down here, you can see like we got the extra things about, hey, make sure you validated the wages, has 3 years continuance. You might be able to get a couple extra bucks. But if you forget the rule about the 100%, our system won't let you forget it. This is why this is far superior to any spreadsheets or most other tools out there. So I go save calculate, and that income drops down. Why did it drop down? As you can see up here, it changed because you're not allowed to use the cash flow adjustments if you are not 100% owner. So it stops you from making mistakes. Now, if I flip this to Freddie Mac's rule set, Freddie Mac, okay, come back in here and come down, you can see it's still up there. It's included. So that's the advantage of using a software-based or basically an intelligence-based system here, is that it's not just a big spreadsheet that you get to choose your own adventure. It will help you follow the guidelines. The same way to TurboTax, right? If you tell TurboTax, I made this money, and say I'm married, and it'll figure everything out and go, oh, well, actually I'm not married, and you click unmarried, it's going to change your taxes because they're guaranteeing their software, if you give it the right answer, or the right information, will give you the right answer. Same with our software, okay? All right, just want to let you know that we do have that ability. Whatever tool you're using is great. This information I gave you hopefully is helpful, but this is what our tool does. I'm going to show you our tool. Obviously, I'm very proud of the tool. It's built by our team, does great, and that's why we do so many loans per month. All right, well, that wraps it up. Here's how you get a hold of us on our website, getblueprint.io. Info@getblueprint.io is the best way to reach us. Hopefully it's been helpful, and we would do these every month. So at least email us and get our newsletter or sign up for our newsletter. These are free every month. We keep doing different income topics, even though I've underwritten files and I'm a DE and all that good stuff. We just focus on income analysis and a little bit outside of that, but pretty much income analysis. So that's our expertise, and we're hoping to help you with it. So, all right, thanks for watching, and we'll see you on the next webinar.